The Financial Survival Network, helping you to survive and thrive in the new economy. To find out where to buy gold and silver reliably at great prices, go get your free Financial Survival Toolkit at financialsurvivalnetwork.com. You'll also get our complimentary newsletter. This is the Financial Survival Network.
1490 WGCH, this is Kerry Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote.
Hello, everybody. Welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Mentum.
And we are 31.5-year Wall Street veterans who have had to take on secret identities and go underground in order to provide you with a handful of ideas we screen for here in the shop each week. You've seen our faces on TV, you've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week, it is June 22nd, 2012. We've run a cash flow screen in the shop. We'd like to share a couple of ideas that came out of that. But first, some important caveats. First, this show is for entertainment purposes only. It's not a guarantee. Secondly, this is a hobby for Mo and I after work. You know, during the week, we are professional analysts. We're doing a lot of important fundamental analysis, projections, management interviews.
Serious guesses.
Yeah, and we're doing none of that here on the show. Third, what's third? Oh, we may not have your best interests in mind, so do your own work. We may accidentally recommend you do the opposite of what's best for you, so don't rely on anything we say here. And then fourth, we've been drinking just a little bit this week.
Less than last week, which is why last week's show wasn't posted.
Yeah.
It did not make it
our
through.
Our wives would not allow that on the air.
Yeah.
All right, so see all our caveats at www.thevalueguys.com, and there's pictures our moms took, and importantly, links to past shows, links to best ideas list. Evidently, we're on YouTube now, so you can go see that. It's all at www.thevalueguys.com. This week we have 4 terrific value ideas. This is really the meat of the show. We like to give a handful of ideas, and we simply are running screens that we use here in our value shop. We're small cap value investors, or I am, and Mo's, of course, on the other side. He can tell you about that. But we run screens here. This week we've run a screen that is called Enterprise Value to Cash Flow. Enterprise value is the market value of the stock, the debt less the cash. That's what we'd have to pay to own the business. And
in theory, it's more encompassing than a PE ratio.
Well, it certainly adjusts for differences in balance sheets and gets at the core business. And then we use as a denominator cash flow, which honestly, I'm doing this in Yahoo Finance. I don't know what they mean, but it's probably operating cash flow, which would simply be net income, depreciation, amortization, and working capital.
So it's not.
Changes.
So it's a pure number. It's not as perverted as earnings can be.
Certainly, it's the actual cash that comes in before you might have to make an investment in your property, plant, and equipment, or acquisitions, or things like that.
So that ratio is, in effect, it's the purist's PE ratio.
I think
Enterprise value more universal, more holistic than earning.
Here's how I look.
Cash flow more holistic than.
If you're looking at the enterprise value to EBITDA, you can compare it to a price to earnings ratio, and what's in between those two, because enterprise value to EBITDA is the whole company. PE is just the value of the equity.
Right.
And then you'd have to look at the valuation on the bonds. The combination, there is a formula there in terms of the weighted average of the debt and the price you pay for that in terms of interest expense.
But it's more complicated and it takes much longer, and I don't know that it's necessarily better.
Well, and enterprise value simply smooths out the differences in the capital structure that you as a potential buyer don't want to know about. You want to know about the business, or you want to know about it separately. Anyway, this week we did a screen that looks for stocks that are under $2 billion in value in market cap, which is considered small. Enterprise value to cash flow less than 10 times. And then I think we put a little bit of a balance sheet filter on there, maybe 50% debt to capital, something like that. This week, I'll tell you what came out of this. 40 stocks. Mo and I have gone through them carefully. And here's the 4 that we're going to talk about. ARNA Pharmaceuticals, ARNA, which I think you picked, Mo.
Yeah, it's an interesting company.
Got a nice chart on that for you, Mo. Medical Properties Trust, MPW. That looks like a terrific yield story. Louisiana Pacific, LPX. This is a bit of a construction recovery play. And then finally, we're doing one because it seems to be in Mo's family, and we want to talk a little about it. His mom asked us to do it. Momenta Pharmaceuticals, ticker MNTA. But before we get to that, we're going to do a little thing we like to call Value Guys Wall Street News. I mean, since we're down there, we might as well pick up a few tidbits and pass them on to the listeners.
Well, obviously the huge news in the last 2 days.
Yeah, no, I missed it.
Actually involves us.
Really?
Bob Dahl, the portfolio manager at BlackRock.
Famous guy.
He's a CNBC regular.
Yeah, he's got a pretty good track record.
Great track record, big time commentator. Today, Wall Street Journal breaks the fact that in his prospectus, when he raises money, they ask, well, how do you invest that money? And he says, quote, we were using this quote, proprietary multi-factor quantitative model, proprietary.
Proprietary meaning his own.
His own.
Yeah.
Which drives our investment. And today, it's finally out. The new fund prospectus says that they're using a quantitative model generated by third-party research firms, and I am breaking it here today on the show. They've been using...
Don't say it.
The Value Guys Value Screen Magic Screen model. And
wow.
That's going to come out.
Mo.
So it's been our model. It's basically been directing the assets of a $3.7 billion fund that has outperformed virtually every other fund for the last 10 years.
And they're using the Value Guys Magic Screen model.
I think you're going to find that in the next week you're going to have
Is that going to come out?
Yeah, I think it's going to come out.
Are you doing that on the side? I don't recall that exactly. You must be handling that division.
Yeah, well.
Are you? We should talk about that.
It's there.
How's Bob taking the news?
He's, not to change the subject.
Yeah.
This is impressive. This is your fund. I'm looking at a graph here, an incredible graph. It has 1, 2, 3, 4. It has 5 boxes on it.
Colors.
Each box has lots of different colors on it. The boxes are actually 3-dimensional.
They are. We worked hard on that.
And I noticed that your fund is at the top upper left-hand corner of all these big, giant rectangles.
It's that moment in time, Mo, we all dream about.
Being in the upper left-hand corner.
Yeah. Well,
does it feel?
It could be in the right-hand corner. I don't think that matters.
But it is on the left-hand corner.
It is.
You're at the top.
It's a red triangle.
And, so what I was wondering is, the perception of your returns are depicted on this page. Which is
conceivably.
Which is created by a graphic artist.
Yeah.
So am I really, is this an artist's interpretation of your life, which is going to be depicted to me? Or am I supposed to buy your fund based off of these boxes?
No, well, that's meant to just depict our performance relative to our competitors, frankly, right there.
So those oblong shoe boxes, all of your competitors are down at the bottom and you're at the top.
Well, no, these are quartiles. So the way they typically show management performance compared to their competitors is they break it into quartiles, and they number them 1 through 4, which I think is very traditional, just to go with that. Quartiles. Yeah. Then they color them. The red is the bottom, and the yellow is the second. And I get it mixed up. I guess the first. We've had a good period. Fortunately, none of the ideas that create this great performance end up on the show. Yeah, we don't talk about the good ones.
So what else?
Just kidding, listeners.
Hey, this weekend, 97th annual 4th of July Nathan's hot dog eating contest. It's going to be carried live on ESPN right after Wimbledon.
Really? Hot dogs?
So
those
Joey
can't
Chestnut.
Be good for you.
A shout out to Joey Chestnut. This is his name, Joey Chestnut.
Yeah.
Last year's winner from San Jose, California. 68 hot dogs and buns, 10 minutes.
Wow. Is he going to be trying to defend his crown?
That's 6.8 hot dogs a minute. That's faster than your kids.
That's Is he coming back to defend that? That's
He's
amazing.
coming back to defend it, and here's what I love. Guess who's hosting it?
I don't know. Mayor Bloomberg.
So he was
Is he going to have milk with those hot dogs?
I don't know, but he was asked, how do you justify sponsoring a competitive eating contest when you're outlawing, supersized soda because you think people are, getting too fat?
Yeah, I'm having trouble with that one, Mo.
Well, here's what he said. He said, quote, this morning, he said, scientists have concluded that obesity is caused by soda, not hot dogs.
Really?
So good news to hot dog lovers this 4th of July. Get out there and eat some because there's Mayor Bloomberg who knows his stuff.
I mean, even 60 hot dogs, then, it cannot affect your weight.
0.
But
so
2
give
Cokes.
give up the soda. So
all right.
That's what's going on here.
I'll give you, I actually have no Wall Street news this week.
None?
No.
You should get out more.
Let me see if there's any around here. Nah, I'll just pass on that. I'll save it. Let's get right to the stocks. That's why people show up here, isn't it, Mo?
They do.
All right. So, first up, stock. Well, you found this one, Mo. Why don't you do this one?
Well, we were looking and we came across Fat Monkeys, and I recognize it as an indie rock band.
Yeah. No. That's been a development.
But in one of our some of our searches get very complicated, and by the end of getting all the algorithms, which tell us, the algorithms actually tell us what to type into Google.
They do?
Came up,
Well, this was 10 times cash flow, remember?
Oh, I know, but the way it got translated was Fat
Yeah.
Monkeys. We Googled it, and we came up with this stock, and here's why.
Okay.
These guys have created a drug that basically attacks the fat cells. Restricts blood flow to the fat cells.
Well, the stock's gone from 1 to 10.
That's why.
So people seem to like it.
Well, I think there's 3 reasons.
Yeah.
What a lot of people are saying is obviously, if this works, they've just finished trial tests with it.
Yeah.
Obviously, it'll work with human beings, and there's a huge market for it. FDA has just approved it. Now they're talking about aftermarket tests, but that's why the stock's going up.
Well, I'm excited about the second opportunity. Yeah.
Here's the hidden story.
Yeah.
Here's the hidden story. They say that they have an experimental drug that, quote, chokes off the blood supply to fat cells and has helped obese monkeys slim down by as much as 30%. And here's what people
a slimmer monkey is a more attractive monkey.
And according to the World Wildlife Association, approximately 36% of the monkey population in the United States is obese. So
that is a problem.
It's a market a lot of people are not figuring in.
Wow.
The other thing is, even before the monkeys, they tested this on mice, and it's an earlier test of the drugs on obese mice helped 30% of them lose their body weight.
Wow.
A third market.
They might lead happier lives then at that
so
point.
I think you've got a lot of different plays here. The stock, hey,
it's gone from 1 to 10.
It's a 10-bagger.
Yeah.
Do they still use that term?
They certainly do. Absolutely, you can say that. Yeah. Well, this stock, it did pass our screen, so it's some kind of 10 times cash flow. I admit I don't know how it managed to do that, because this says enterprise value $1.8 billion, net operating cash flow $50 million, but I'm sure I'm not calculating something correctly. But the market value is $1.8 billion, and the sales are just $11 million. So there's a little ratio we use here in the value shop over here, which is called price to sales. It's not particularly fancy, but it does the job like a hammer. And this one is 164 times sales. So again, I like to see them under 1 or 2, but this one's
and obviously, what the market is saying is that even within the next year, if this gets approved, these sales, which are sales of other products, very small products that they're selling, if this gets approved, sales of this one drug.
Yeah.
If you really add in not only the worldwide obese population, but the monkey obese population and the mouse obese population.
There's a lot of mice, and a lot of those are overweight.
$172 trillion market.
Wow.
Yeah.
How much are mice willing to spend on this? Their whole
owners. That's the question that they all ask. It's the owners that are spending, and they'll spend a lot for their mice
because they want attractive mice.
You also want them to live a longer life.
A lot of mice aspire to be models, and with this, it's going to be right up their alley at that point. Okay,
but I agree, the valuation's a little weird.
So how would we figure So let's see. There's 300 million people in America.
Do you like to go to Vegas?
If it's cold here.
Then you don't want this stock. Next, no, Louisiana Pacific.
All right. Louisiana Pacific, ticker LPX. Why are we talking about this? I'm not sure entirely, but one of the reasons is it's less than 10 times cash flow, and that's one of the advantages of doing a screen. They all passed.
And it's got a good stock price. Even the 52-week range, the stock's gone from 4 to almost 11.
Well, here's the story on Louisiana Pacific. They're a provider in the construction industry. They do wood products, materials, structural framing, exterior siding, light commercial construction, other various things. But it's wood and housing and siding and things like that.
It's good that we actually read the fine print, because last week's show, which was canceled because of
excessive drinking.
Technical difficulty. We did the same company, and we thought it was a railroad.
No. Did we? Louisiana Pacific.
It's a good thing that shows.
I thought it was a state initially. Like, who's the governor? That's what I want to know. Louisiana Pacific. Here's the thing. It looks interesting, but and so I chose it. I don't want to get too down on it. But their sales. The housing industry is still under a lot of strain. Their sales for this year. We'll just say last year, $1.3 billion, and that's down from 2006, which was the peak, $2.2 billion. So they're down, I don't have a calculator here, but that's roughly, let's just say 40%.
Right.
The EBITDA back in that peak year, $241 million, okay? Last year, zero. In 2010, 77. Somehow they managed it, but then the prior 3 years, big negatives.
So let me ask you a question. I don't understand this business. I never look at them. I'm going to just read you the last couple of years of EBITDA margins.
Right. No, well, that's...
So if I start in 2009, how does this explain this to me? Because it doesn't make sense.
Yeah, sure.
I look at this and I say, okay, -6 in 2009.
Yeah.
+6 in 2010. 0 in 2011. Plus 5.5, call it 6, in 2012. So I'm going, 0 to 6 to 0 to 6.
Well, just look at the sales. These guys are...
They're that sensitive.
They're very sensitive. It's a lot of fixed costs for mills and factories that cut wood and all that infrastructure. So you see these little changes. To go from -6 to 5 was just a sales going from $1.1 billion to $1.4 billion.
So there's that much fixed cost in the business that when you get a little bit of an uptick, well, I'll tell you.
Well, that's why. So look, in the year ending this year, 2012, the estimate is for $80 million in EBITDA. So I just want to say the enterprise value to EBITDA, which listeners have heard me talk about as some estimate of a cash-on-cash yield for a long time, that ratio is 187 today. So 187, the inverse of that, that's a 0.005% annual return, or half of 1%. Now, what's interesting about that, it sounds ludicrous, but remember, the long treasury is at 1.5. This is 1/3 of that, plus you're going to get growth. Is it going to be more than 2%? What the market's saying is, yes, we are burning through our housing inventory. The numbers on people per dwelling, actually, for the first time in 50 years, had ticked up. That's not that's not going to be a static situation. Credit's starting to ease a little bit. Despite the fears right now because of Europe, the economy in the United States is curing. We talk about that on Walking Through Economic Trends. And so the market is saying these guys are going to get to some of their old levels. Why? Capacity has come out of the industry since then. These are one of the guys still standing, but I'm going to guess at least 1/3 of capacity in these areas has come out. Population is up, and people still want dwellings. Just ask yourself, would you like to live in a dwelling? If you're saying yes, then here's another question. Do you want to live with some strangers? No. Okay? That means housing is still, okay. No one's living in their car on a permanent basis. So the market expects these sales to get back to these old levels. And I'm just going to suggest part of that is already in the stock because the market's so sure of it. And that's a reason why this is selling, at such a low earnings yield right now.
Now, Val, let me ask you a question, because this has got to be an eye-opener. And there's clearly an industry story here that I'm not getting because the stock's acting well despite this history. But if I go back all the way to 2007 and I just look at ROE, -8, -37.
Well, those are all just from the losses.
Right.
Yeah.
And so this company's had 1, 2, 3, 4, 5, 6 years of losses.
Yeah, it's been a tough period.
So if it were me, I would spend at least a minute or more, look at their balance sheet to make sure that they haven't been bled to death and they're about to die as the race is about to take off.
Well, their debt to cap is 40%.
Right.
They did just do something that, people should like. They had a 13%. They had a 13%. So back here, when the stock went from 10 to 1 back in 2008, anything with debt, people got scared because banks just simply stopped loaning money. And these guys got caught up in that as well. The stock went from, at one point, 10 years ago, the stock was, it looks like around 25 or so, maybe higher, and now it's 10. So clearly, some value has come out of the stock as sales have fallen. But what they had to do back then was they had to take on, just for survival, a $234 million piece of debt. They paid 13% interest on that.
Oops.
Last week, they paid that off. Okay? So they've paid it off, and I think they're probably going to have to roll that into something. But if I just take the interest on this thing was about, $30 million. After tax, $20 million. They were paying about 15 cents a share in interest. If they can manage to fund this with cash, and I'm looking for a cash balance here. Do you see one, Mo?
Yeah, cash. Well, they have 340. No, they have nothing.
Okay, nothing. So they may just have to go get another loan, and maybe this time they can get 10% instead of 13. So they'll pick up 3%, which is, basically 3% would be about $6 million. After tax, $4 million. And how many shares are there? 150. So they're gonna pick up a few cents a share in earnings.
They will, and I think they have finances. Take a look at this cash position. It was 2009, 390,000, 390,000 million, 340 million, and 2000 beginning of this year.
Unless those are thousands, what do you think?
No,
those are millions. Yeah.
So unless I'm missing something, that cash, which has been on the balance sheet for 1, 2, 3 years, all of a sudden was spent in the first half of the year.
So maybe they used cash.
I think that was
if that's the case.
So that's just not reflected yet in the decline and the impact to earnings.
They're going to pick up 15 cents a share then.
In the second half.
Yeah, and what that does, let's just put a multiple on that, since it's so certain that they're going to get that from now on because they paid off the debt. So we're certain they're going to save 15 cents a year per share.
So put a multiple on that, and that's what the stock price has done.
It's worth $3. The stock's at 10, and it didn't change much in the last little period here, maybe a little bit. But the point is, just by paying that off, they picked up $3 in value on a $10 stock price. And so the market, again, these little incremental changes, if demand comes back, their margin's going to go from 5% to back in these good times, it was 10.
Right.
So here's what the market thinks. Sales could double, and the margin could double, which means margins could quadruple, or rather EBITDA could quadruple, and you're willing to pay in a little advance of that because the trends over history in housing and people wanting homes is so solid. So it's an interesting play just on, do people want to live in houses? And if your answer is yes, Louisiana Pacific may have some upside to it. So take a look. And then... what? Is that what we done? Oh,
medical,
no. One more.
Medical Properties Trust.
Medical Properties Trust, ticker MPW. This came to me in a screen, Mo. In a screen one night. 10 times cash flow or less. All I can tell you about this one is they're a REIT. They own a bunch of healthcare-related real estate, which means I think It's a good market for a lot of years, good demographic trends. They're going to get their rent paid, and they have to turn around and pay out 95% of their cash flow to us.
Which is a 9%.
Yep, 9% yield.
Oh, let's just say that again. It sounds so good.
9% yield.
Wow.
So, if you have a friend or a loved one, or yourself maybe, that's going, what in the world? I'm getting nothing in the money markets, nothing at the banks. What do I have to frickin' do to get some yield? I'm suggesting Medical Properties Trust, ticker MPW. A couple of other stats. They're doing an 86% EBITDA margin, which to me says they own properties. They have a lady, she picks up rent checks, she walks them down to the bank. That's it, and then they pay that out to us. They have $2.2 billion in assets. That's been growing very nicely. 7 years ago, it was $700 million. So the assets are growing nicely. That represents just them buying new properties along the way. They're taking on some debt to do it. So it's a very interesting ongoing business model where they have some property, they get some rent, they get a little more rent, they get a little more loan at the bank, they buy another property, and then meantime they're paying out all the cash flow, 95% of it, to us. The estimates are remarkably stable, as you can see.
Which you would expect on a REIT in a stable market.
And then, some of the valuation metrics here are a little weird because it's more of a royalty type of model, rent on buildings you own. But the one metric that's nice is price to book. Presumably, these book value numbers are close to market value. And so you're paying a little bit of a premium to the liquid value of the properties, and you're paying because they're managing it and they're going to grow it for you, and you're picking up a 9% yield. So I think, this is a tough time for yield, and this is a very serious opportunity, I think. So, we like to goof around here on the value guys, but Medical Properties Trust, MPW, it's real.
Yeah, now,
real.
It's that time of the show.
Which time?
That time.
Okay.
Guess the dividend.
Guess the dividend.
So
we have some theme music for Guess the Dividend, Mo?
Maybe you can splice some in later.
Yeah, what are you thinking?
I don't know, maybe the theme song to Shaft.
Oh, okay, yeah. Can we legally use that? Anyway.
So, here's a question.
Yes.
Obviously, the 9% yield, you buy the stock for the yield, everything else about it is stable. And the key is you want to know that dividend is safe. At worst, maybe it would go up. So when you look at a company like this, you want to ask yourself not just what's the dividend now, but what's it likely to be next year.
Or what has it been, Mo? I forgot to mention, they did cut this dividend at one point.
That was a long time ago.
Like 5 years ago during the midst of the crisis to save cash, I'm sure.
Fair enough, that's true. But what you can really look at is a little more recent history and just make yourself comfortable with the fact that you're going to get the dividend that you're buying this stock for.
That's the key thing here is you're going to get the dividend.
I'm going to read you the dividends.
The dividends.
And you can use your computer. You can use the abacus over there on your desk.
Let's have a little music. Guess the dividend. Okay. That's our creative department.
So, because now we're using very advanced algorithms. You're going to be using the.
Wait a minute. Let me adjust the horizontal here. Okay.
So 2009.
Yes. Hold on. Okay.
80 cents.
All right. Let me enter that.
2010. 80 cents.
All right. Now, is Bob Dole going to be paying attention?
2011. 80 cents.
All right. Let me enter that in.
2012.
Yep.
80 cents.
Okay.
Okay, you have 25 minutes for your answer. Okay, we're back. 20 minutes have gone by.
Okay.
And
I'm sleepy.
What have your algorithms come up with for the next year's dividend?
82 cents.
Well, there's your alpha. Because I think a lot of our readers might have said 80 cents.
Right.
But this is why you hire professionals.
We have the systems.
That's why. Onward.
Okay. Onward to what? That might be the end of the show.
At the end
we
of the show.
do have another segment.
Oh, yeah.
Unless you're entirely bored with this, then just go do something more fun. But we're going to do something called paging through national economic trends, and since we
weeping through
and
drinking
national economic trends. Now, we do this segment. We've been doing it for a lot of years. We're looking at some documents from the Federal Reserve Bank of St. Louis, National Economic Trends, and there's a companion piece, National Monetary Trends. This stuff is must-read material if you want to know what's going on in the economy. And if you don't, then don't worry about it.
And
right?
the thing that's great about it is you can look at it online, and you don't really actually have to read it because it's just a series of graphs.
Just
if you
pictures.
spend a little bit of time, research so
like
you get
a Chinese
an idea
restaurant, really.
what each one of those mean.
I like that chart. You know, that kind of thing.
So work on
All right, so we're starting on page 1. That's just the cover page, so I'll just pass that. Page 2, do you have anything there? No.
Was that a
3?
meh?
Page 3, All right, I got something here on page 4. A lot of talk about gross domestic product, what's going on, etc. And you've got 25 years here, and I would just say that it appears to me that we did have a little slowdown in 2011, but we're getting a little bit of a flick up right now, and that's continuing.
A flick up?
A flick up.
Is that a technical term?
It absolutely is. And then to support that, because GDP's got a lot of stuff in it, and some of it doesn't make any sense, so just trust me. But just below that is something called industrial production. This makes a lot of sense. It's all the stuff we produce. And this thing is going up right now at about I'm just going to say about a 6% annual pace. It kind of troughed out at around 4 last year, but it's been going up since the summer of 2011, and it's right now year over year industrial production up 6%, and so we're expanding. That's a good trend. I'm not sure people know that. So there you go, little data point.
I got a stump the expert question for you.
Okay. Where are we going to get an expert, Mo?
Yeah, that's a good question. Well, we'll just put it out to the audience.
Oh, the audience then.
So I'm looking at page 8 in this printout.
Page 8, yeah.
It's
skipping ahead.
25 years worth of interest rates.
Yeah.
Page 7. Sorry, page 7.
All right.
25 years worth of interest rates.
Yeah.
For the last 4 years, we've had interest rates close to 0.
They're just hugging the ground there.
They're hugging.
That's the 3-month treasury you're looking at.
Have we ever seen this in history? Because this goes back to 1987, but it doesn't go back to prehistoric times.
I think you got to go back to the 30s, which we don't have that data right here, to see what in the world we were doing then to try to combat the problem. I will note the Federal Reserve, I believe it came into existence in 1913. So they were up and alive and well during the Depression, and we should go see what they were doing. But if you try to spur an economy, as I say, you can't push on a string. All you can do is put interest rates to 0 to try to spur people to do something. And that's when you hear that phrase. It's like, what else can they do? They can lower interest rates, and then they can put money into the economy by buying bonds. And so when I buy bonds, I'm the Fed, I'm spending money, sending it somewhere, and they believe that's going to kind of move around in the economy.
Well, it would be an interesting academic study if I was getting it. If I was a graduate student looking for a thesis, I would say
but that was like 40 years ago, right?
Yeah, 44 than
yeah.
I'd write a paper on the following: we've had 0 interest rates for 4 years in a row. When was the last time in history we saw that? If you have to go all the way back to the 30s. When interest rates finally rebounded, and you got 100 years of history telling you that ultimately they will, where did you make the most money back then? Does that work today? That's where you put 100% of your money. And
I don't know about that. Here's the thing about low interest rates. It's very interesting. You say, low interest rates, it doesn't cost me a lot to borrow money, so that's good. And in some sense, it is good. It promotes economic growth. It's trying to do that. Here's the downside, okay? Of all the good ideas in the world, it's a nice discipline to have to pay for your capital. Because if you don't have to pay for it, you might get a little sloppy on your idea. So all of a sudden, in order for us to make money with interest rates at 0.5, we only need to have an idea that can earn 1% returns or 2%, and we're feeling pretty good. Whereas when there's higher interest rates, it actually helps the growth because, in effect, it's putting some discipline in that if interest rates are 6%, you need an idea that can generate a 7 or 8% return in order to be profitable. So low interest rates actually, in my opinion, put a little pressure on longer-term growth, in part because there's dumb ideas getting money instead of having to filter just the best ideas. And so that's...
that makes sense. And I would only say that that has historically been the case, but right now, even with interest rates as low as they are, find me someone that's been able to renegotiate their mortgage. The banks are, the rates are that low, but the banks are not making that many loans.
Well, that's true.
So
the prices are low, but they aren't selling anything.
Right, exactly.
Yeah.
So keep going, because I got another stump.
I'm going to move back in page count to page 5.
Well, that's confusing.
And I think that what's interesting, there's a chart here on the bottom left called Real Change in Private Inventories. And it's not a reality TV show, although it could be with that title. These are the billions of dollars, 2005 dollars, that are invested by private business of their own volition. No one's making them. They just do it in order to, earn a little money. And they're pumping right now $50 billion. Most recent quarter, first quarter 2012, looks like $60 billion in inventory, and that means things that they expect their customers to be buying soon. So it reflects confidence in the economy. Again, no one's arm twisting them or forcing them. Just the sheer interest in earning a return on capital leads them to be pumping, in the last 6 months, $100 billion into the economy through inventory, which means goods across all industries, which means it goes to pay for employees and buildings and all kinds of things. And so the annual pace is $200 billion, and they're just getting started. So this thing doesn't go back very far, but I think that in good times, this number can be easily twice what it is. So if it's 100 or even 150, you start to have a private engine just in inventories. That's before property, plant, and equipment, and people and all that, of what could start approaching $600 billion a year, every year. And I think that puts into perspective when you start talking about an $800 billion stimulus package that's once, that's really not what's going to get you going, because the private industry is prepared to put in $600 billion just in inventories every year once the economy gets going. That's the true engine of economic growth, is private industries investing. And we're getting back to some levels that start to allow this thing to start going a little bit. So I think that's very important. Thought I'd mention that here on the show, Mo. Private inventories. And then I had another one here, and this was a very patriotic one.
I see the little flag, flag you drew there.
So page 9. Of national economic trends, there's a little chart called Oil and Natural Gas Prices. And what's interesting, and I might have talked about this before, is that gas prices, because of all this new shale gas that they're discovering,
fracking,
have pushed gas prices down to $3 per 1,000 cubic feet, which is how they measure that. And in order to convert that into what if I had barrels of oil, you multiply it by 6. So 6,000 cubic feet of gas has the energy equivalent of 1 barrel of oil. So here's the thing. 1 barrel of oil costs $85. The barrel oil equivalent of gas costs $15. So it's an enormous gap in energy prices. It's only happening in the U.S. Why? We have the technology to do fracking. Other nations don't, okay? And it was really driven by the fact that the government came down so hard on environmental rules that there wasn't, an opportunity to drill as much as you'd like. So you had to basically go into, reservoirs that were already passed over and figure out a way to crack the rock and get the trapped gas out. And it's been an enormous success, And so we now have, in effect, the rest of the world is paying $85 a barrel for energy, which a lot of times is, 20% of your economy, or 15 to 18 anyway, in the advanced economies. We, instead of 85 that everyone else is paying, we are paying 15. This is enormous. And just in the last 3 months, a couple of giant chemical companies, one being Dow and I think the other one being Celanese, have announced new chemical plants here in the United States to take advantage of these low energy prices.
Now, to be fair, while the gas prices, natural gas prices have come down, not every industry is outfitted right this very second to make use of that.
Well, no.
Now, I know that the huge trucking fleets are actually converting their trucks from diesel.
It's starting to happen.
And Boone Pickens has been a big proponent of all of that.
He's been talking about that for a long time. He has
but it's going to take some time to re-engineer a lot of the existing
this is
oil.
Happening.
Yeah. But
on the engine side, there's a lot of great engines. It's going to be, building out the stations, and if you can move vehicles to natural gas, that's going to be an enormous benefit to the economy. Just in cost savings for every family that's now paying 20% of what they were for fuel. But in the meantime, we're getting the benefit of it through these chemical companies and other firms that use, gas and oil. They're switching from oil to gas, and it's going to be an enormous help to growing the economy. So I thought that was weird. And I did write Go USA.
I saw
Go
that
USA.
With the flag and everything.
So,
well, I'm on page 17.
Yeah.
You can tell me if you get there, if
page
you see 17. Something for me.
Well, on page 13, it's just, these are monthly bars, but the last two have been real disposable personal income. That means after inflation of 0.2% in each of those months. If I multiply that by 12, that's 2.4% growth in personal income. And
now we've had a lot of head fakes in that category. We've had 2 months of movement forward, 1 month back. 2 months. Look at that trend historically. 2 months going forward, 1 month back. 1 month going forward, two flat.
Yeah, but now for 5 months in a row, forward, flat, flat, forward, forward. So it may be a little better trend.
Yep, sounds like a dance step.
And then the last one I had this week, Mo, and there's so much in here to talk about. People should just go look at this Federal Reserve Bank of St. Louis National Economic Trends. But on the bottom of page 13, consumer sentiment, University of Michigan. This kind of tells you what mood people are in. And when people are in good moods, they buy stuff. This thing's been going straight up since the fall of 2011. And the most recent blip is a blip even more up than it was going a moment earlier. So I thought that was a very positive trend, and I think some of the gloom and doom that's on in the market right now is a head fake. I think things are looking pretty good.
One quick question, historical question, stump the expert. There's a chart on page 17, very standard. You see it all the time. It's called federal debt.
Yeah, ouch. Yeah.
And federal debt, this goes back to 1988.
Yeah.
Federal debt has been as high as 70% of GDP and as low as 55% of GDP. And that's sort of where it's fluctuated. Good times, bad times. And boom, beginning in 2008, we have climbed out of all historical ranges and we're zeroing in on 100% of GDP.
Yeah.
That ever happened before?
This chart doesn't go back. I have studied this because this is the most, this is alarming, but also just the percentage of GDP that's government spending, and those two kind of go together. I'm going to guess that in 1945, this was this bad, because World War II was an enormous effort, and that's the last time government spending as a percentage of GDP was as high as it is right now.
Of course, they had the post-war boom to dig them out of that hole,
actually,
and we do not have that.
It was amazing because over the next about 10 years or 15 years, they really got that debt down to a very reasonable level. I mean, not to zero, but it's been, and I don't have this chart in front of me, but my recollection is it was going down from 1945 to about 1963, sort of in that range, and then the whole buildup of Medicare, Medicaid, all that stuff started kicking in, and all those numbers have been going up ever since, which is 50 years. And, you
Right.
know, obviously if your children, you know, they started out with a little bit of an allowance, and your income was flat, and every year they just kept taking more and more allowance, pretty soon, you know, they'd have more money than you. And that's what's kind of happening right now in America, is the government is, you know, getting a little bigger than those of us that are non-government, and that hurts growth, because government traditionally is not that smart of an investor. I mean, they have roles to play in society. Investor traditionally isn't one of them, and so when they do invest money, it's got a lower return than when private business invests, and what that translates into is a lower growth rate, and what that translates into is lower wealth as you go out 10, 15, 20 years, when your grandkids will, you know, want a car, and it might be a little harder to afford. But fortunately, these things do seem to be kind of trying to reverse out. As you can see here, the most recent change in federal debt was still up, but it was up at a slower pace than in 2009, when, of course, we basically, bailed out the banks.
Yep.
And so, but yeah, it's a scary trend for sure.
One last, very quick one. Going to just test the expert on page 21. There's a chart there that says, because I thought this is striking, corporate profits as a percentage of GDP.
Yeah.
And I'm looking at this. This is a 26-year chart.
Yeah.
Corporate profits have averaged about 8% of GDP for years. You know, they come up a little bit to 10, and then they go back down. They come up a little bit to 10 or 11, they come back down. So that's for 26 years. Corporate profits as a percentage of GDP right now are 13%.
Yeah.
Highest they've ever been in 26 years.
Yeah.
Does the market sound cheap based on that? Or should it sound cheap because maybe the reference or the comparison to GDP doesn't carry?
Well, I would like to point out to people that corporate profits, they are right now at the highest level as a percentage of GDP in 25 years, but 4 years ago, as you could see, Mo, they were at the lowest level that they were in the prior 20 years. And so things have been a little volatile. There's a couple things, I think, affecting corporate profits, which means helping capitalists, people who invest in property, plant, and equipment. What they're finding is, because of global trade and global competition for work, and we've seen this, labor costs around the world have been going down. In other words, when you can move a plant to Mexico or China, get your labor costs reduced, laborers are upset about that, but the question is, do people with money have the right to invest it wherever they want? And I think if you look in your books about what America is supposed to be about, you're supposed to be able to do what you want with your own money. And so corporations, in terms of helping their shareholders, move to the lowest cost facilities, and that's been helping their labor costs, and that's been helping their corporate profits. I think the other thing that's been going on here, and it's simply, and we see this in the productivity numbers, is that with the internet and other technologies, but you sometimes just simply don't need to hire people. And when you let people go in the depths of the recession, because if you don't, your firm will run out of money. When business picks up, you start looking around and you go, hey, where's Jimmy? We don't need Jimmy anymore. We let him go, we laid him off, but now on the way out, you don't need a librarian, you don't need a secretary, you don't need a receptionist, you don't need a filing clerk anymore. And so there's so many things we don't need. We were talking a couple weeks ago, Mo, how our first jobs were to fill out big spreadsheets with data to hand to the senior people. That's a button on my screen now with my old job. So I think what's happened is business is finding ways to produce more by making people much more productive. And
they talk about there's a BMW plant everyone talks about in North Carolina where there's no people on the floor.
More people, yeah. But on the other hand, I'd like to, because again, this is controversial. People say, well, wait a minute, companies that don't have people, is that really good for America? And I'd say, Yes. Why? Those people are doing something else. So the factory's making a bunch of stuff that we all get to use or buy. But then the people that used to be there using up their day doing that, they're free.
They're on the streets, right, where we see them outside. They have little signs.
Some of them are, but not all of them are. The unemployment rate is not 50%. It's 8%. And so, and we go through time, there's always people that are moving from one career to another. Oftentimes, those are the people that invent stuff and do something great. I think, Jeff Bezos, he left our industry.
And he was an unemployed auto worker. He worked on the right, left-hand hubcap.
Steve Jobs, he got fired from Atari for being a goof-off. Would there have been an Apple computer if he would have not been fired? So,
of course, if Steve Jobs was driving a forklift truck, maybe he wouldn't have gone on to found Apple.
Well, that's a pretty good job, right. So I think that you got to think about what makes economies go. And at the founding of our nation, 98% of the people...
Can we play patriotic music?
I could lay this in. Yeah. But they were farmers. They were farmers. And you might say, oh my God, I see a future where none of us are working on the farm. We're not working on the farm? What are we doing? I don't know. Oh my God. That would sound scary, but in fact, 3% of the people work on farms now. And that's good. Everyone else is doing other stuff that is good. So I think that...
and the people that couldn't transition died.
Well, or they, they're still living at home with their parents, a couple 100 years old. So anyway, you've managed to spend another hour or 52 minutes listening to the Value Guys. And so we appreciate that, I guess, Mo, don't we?
Yeah, shout out at the end of this show to BlackRock. Thanks for using our screens.
That's a lot of good publicity for the Value Guys.
It's going to be great. I think it's going to be great.
So check all our past shows out and other various things at www.thevalueguys. This has been the June 22nd, 2012 edition of the Value Guys Stock Talk Show. And thanks for listening in, everybody.
And have a great weekend.